Well, that was one of the worst FOMCs that I've seen in a long time. Not only did we lose the man, the myth, the legend himself, Jerome Powell, and his infamous good afternoon, we got a Fed chair who was specifically picked to lower interest rates say instead, yeah, we're gonna hike. Now, I don't think that they'll actually hike twice like the market priced in, but his unrelenting commentary that inflation is a choice did come off as slightly more hawkish, and the market certainly responded that way. As an American citizen, sure, price stability is great, and in the long term, it's great for markets too. But in the short term, today definitely shakes things up. Who knows? Maybe we'll get an additional task force for handling shakeups. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 4 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off tonight with a closer look at the daily timescale, and the first thing we should try to figure out is what exactly is going on here from a trend perspective. Now, undeniably, this is the all-time high. It's the highest high in the trend count, and therefore, this is a potential lower high, which is a little bit of a red flag. We'll talk about why in just a moment. We also know that this was a low, and this is inherently a lower low from here to here. So the daily trend is potentially down, unless you believe this is going to save the day as a higher low, and I should even put in a P in front of that HL, potential higher low, that's going to keep the daily trend a little bit more neutral. Now, a few comments here, and we'll move to the hourly chart. Generally, if I'm looking for a higher low, I'm much more confident in buying that higher low if we're pulling back from the highest high. Question, are we pulling back from the highest high? Survey says, no, we are pulling back from a potential lower high. Next thing to point out, did the market act respectful of the gap fill reversal over Friday's high of last week? No. Did it act respectful of the daily 20 SMA? No. So those are a couple of red flags paired with slightly elevated volume here, right? I would say usually elevated volume on a dead low might indicate capitulation. If you're just pulling back from a potential lower high and still seeking a higher low, elevated sell-side volume means to me that everybody's kind of willing to give up their shares. They don't want to buy more here. It's like, no, let's just unload this, right? Now, it was an FOMC day. We had some catalysts, right? So I'm not going to say volume is the end of the world there, but let's get a little bit more nuanced on the hourly chart. And I just want to walk through a few things. Again, best situation to be buying gap fill reversal as a potential daily higher low is if you're pulling back from the highest high. We just talked about how that's one red flag. We're pulling back from a lower high. Now, is it the end of the world? Well, that's also where we have to kind of talk about competition of the timeframes. Not really, because the hourly trend is actually quite interesting here. You've got lows, you've got equal lows, and we know that the neckline here, if you just want to call it a double bottom, is fine. That was broken, and we brought in a higher high on the hourly trend count. And on Monday's gap up, we technically brought in an even higher high. So the hourly trend is up here. And we know that when you're pulling back from a highest high in a trend count, you can afford a higher low. And again, this is where I understand you're obscuring the time frames a little bit. The daily is a potential lower high. The hourly is the highest high. In a picture-perfect world, you pull back, you respect the 20, you leave some of this gap unfilled, which indicates that we have strong buyers, and then you're back up on the horse, going out to the equal high on the daily. That, of course, did not happen. Okay, next picture-perfect situation is that you go for the full gap close, you support here, you're higher, and then you're going back up to the all-time high, the equal high. That also didn't happen. But is this a lower low on the hourly trend count? Like, point to the last higher low in the hourly trend count. I would say you had low, equal low. You could call this a soft higher low. The 15-minute trend never flipped to down there. So this is generally just a pullback from the highest high in the trend count. And ultimately, does this qualify as a higher low from, let's say, point A down here to point B? I would have to answer that question with yes. The trend on the hourly chart is technically up with lows, potential higher low, highs, higher highs, and an even higher high. Not respectful of the gap fill, not respectful of the 20, fully admitting all of that, not the cleanest pullback by any stretch of the imagination, but hourly trend is technically still up. And in the after hours, right, you could see here in this little box, the bid-ask spread is suggesting that the forecast open tomorrow, and there's a lot of time between now and 9:30, so we'll see where we open, come back out to the pre-market prep tomorrow morning at 8. But if we open here at like 7:45-20s, like the market's suggesting right now, this acts as your higher low. You've got incremental room for a look below and fail back up to the scene of the crime, aka this area right here, 751.75. Hourly has, okay, higher low, you need to flag out, and this might happen early next week, but we're just talking about trend configuration. equal high, the hourly trend remains intact. You can afford a deeper hourly pullback at that point. You could do something that looks like this and overshoot. And then what? You're looking like that. So that if you're a bull here, this is what you want to see. You kind of have to see, I shouldn't say have to, but you ideally see a higher low established tomorrow, Thursday, no deeper than 744, staying over the gap fill reversal area. If you're not so bullish and you're thinking, okay, this is all just like, this open higher is no good, it's going to rally and fail, fine, I'll give it to you underneath 744. I would neutralize my tone. Right now, am I going to be absolutely a bear? Probably not if we're holding on to the low from today's session, right? Why? Because once again, this is the hourly higher low that must hold. We must hold over the neckline of the double bottom reversal at 738.15. If we get something that looks like this, you're back to here. Maybe markets are constructive early next week for something that does that, back to the scene of the crime. I'm left with no alternative than calling this a higher low in the trend count against this low that was set here. This would also be happening above what? The upward sloping daily 50 SMA. If this fails, you could probably see where the bear thesis comes in. If you're a big bear and you want to start the short here, that's fine, risk reward into the equal low. You're ideally, though, looking to balloon runners through some of this thin structure on the break here. That's that news candle, right, on Thursday of last week. And you're ultimately looking for a weekly close underneath 738.15. Let's just play the game real quick. We'll go to the daily chart. Well, just back to this chart, I should say. Let's go to the weekly bar. If you're a bull here, you probably don't want to close anywhere close to threatening the weekly shelf again. After a look below and fail on the hammer from last week, this week you want to see that be bought up again. You want to see a constructive close over this level, which we just talked about, 744. That way you at least have some progression of the weekly trend in the upward direction on the bar-to-bar count, right? So we know where we're bullish. We know where we're bearish. Let's go back to the daily chart here. We could quickly, what else can we observe? Let's just throw on an Fibonacci pull from here to here. There we go. In terms of this stack and the midpoint of that stack, I think we could all agree, and we'll even just go to the hourly chart to see this with a little bit more detail. Your 38.2, in this case, you could pull this in the opposite direction. That would act as a 61.8. It's a line in the sand. As long as we're above this line in the sand, then fine. I would think that things are slightly more constructive as opposed to being outright bearish. The best situation, once again, is getting above and staying above 744, which is not perfect with the 61.8, but it would technically suggest, okay, we're in the neighborhood of improving the odds for a retracement back up towards the top. Let's take off that Fibonacci pull in here. Let's throw on the intraday anchored VWAPs, a couple of key points from this perspective, and then we're moving forward. If you take a look at where the forecast open is at 745.27 by 30, somewhere in this neighborhood here, we're opening above the all-time high anchored VWAP, which is a key inflection point. As long as we could stay over that 744 on quick look below and fails tomorrow morning, generally speaking, if you think about your average participant based on the volume-weighted average price, they feel okay. That's a great reference point there at 744. We would also be above the character change anchored VWAP from Friday of now 2 weeks ago. We would also be, if we start to retake the opening print or if we start spending more time over 745, we'd be over the anchored VWAP from the low of the news candle, which of course, when the deal was announced as, hey, we're figuring out this MOU with Iran, right? That's constructive. Even more constructive would be breaking the anchored VWAP from the pivot high that we've set here. From this, let's go ahead and take a peek at, let's actually, just one last time. If the market's going to balance through the remainder of summer and you get some sort of big washout and, oh my God, the weekly bar is ugly, you kiss the 50, you bounce a little bit, you do this. If the market goes sideways up here for 3 to 5 weeks, I wouldn't be shocked. Right? Why would I not be shocked? Because that's typically what's required for a weekly high tight flag. Not that this has met the requirements of, moving over 100% from the origin of the breakout, that April 8th gap up, but you get the idea. This would be a weekly flag if we just balance up here for the remainder of summer. I know it wouldn't be what a lot of people want. A lot of people want just the straight up continuation of this trend for higher and then new highs, but sideways wouldn't be unreasonable if we get the bearish close. If we open here, close on Thursday, Monday of next week, wick the 50, support here, back to the midpoint, kind of struggle back at the 20, a little bit lower. A sideways neutralization of trend, just to say it out loud, I know it's not as fun to trade, but it would be okay if the market did that, right? Let's jump on over to the market internals here for the S&P side, the NICE side of the exchange. If you're not familiar with market getting ahead of myself. Market internals, check out the video tutorial in the top right-hand corner. Volume outflows, of course, were severe. That's always going to happen on an FOMC. Same thing with the AD line, same thing with the index score, very heavy into the close. What I did find kind of interesting is that the cumulative build didn't really do anything all that big. You had just a lot of volatility here into the afternoon. afternoon. So the biggest thing walking forward, once again, is figuring out tomorrow, does the market want to accept above 744, worst case scenario above today's low, or does it want to accept below those levels? If it's happening on neutral internals and we're accepting above, great, I'd be a little bit more optimistic. If we're accepting above on screaming bullish internals, guess what? I would expect early next week, we likely start heading towards the all-time high. If we're accepting just kind of neutral in here with bearish internals, okay, early next week on a weak close probably seeks lower, back for another kiss to the daily 50. That's the market internals interpretation, and tomorrow's close should be pretty telling, especially after an FOMC day. Let's jump on it because now market participants have something to base their decisions on, right? Do we or do we not believe that Kevin Warsh is more of a hawk? Let's jump on over to Market Profile. If you're not familiar with this software or this type of chart, check out the video tutorial in the top right-hand corner. What do we see here? On FOMC, typically, right, you're going to get a lot of volatility. It doesn't give the market actually enough of a chance to establish value at a key level. This volume down here easily could have pooled more volume. And so I think that, yes, this does look like a P-shaped profile, which would typically indicate short squeeze, but we didn't open down here and put the post in early. The post is late, which is just like a midday liquidation break on Kevin Warsh. Value, for the most part, is elevated in here, and that would just suggest what? If the market is going to respect the gap fill area, think of this as being 744 on the Spider's cash chart that we were just looking at. If we're above that, then we are mostly trading within value from today's session, and that is neutral. That is not bearish. If we reject value area by doing something that looks like this, that's the bearish configuration we just talked about on the hourly trend count, you would understand, and I think we could all agree, I would say, instead, is just that this value overhead, if you're long, you're disappointed. If you're short, you're feeling on top of the world. So 744 not only is the gap fill reversal equivalent in here, it's also value area lowish. And that to me is an important inflection point. So market profile aligns with the levels that we've seen thus far. Let's jump on over to the NASDAQ side of the market here, which is slightly better, I must admit. If we take a look at the NASDAQ, you can see in the daily trend count, we have the same conversation about the potential lower high. You've got the same conversation here for the potential higher low. But the higher low is much more meaningful on the NASDAQ. Why? Because it's right at the gap fill level. Yes, you overshot the daily 20 SMA by a little bit, but any sort of quick red to green move, and keep in mind, this is even better in the after hours, 729s in the after hours. That's right about in here, very close to the previous day's lows from Tuesday. So an open there is going to give you plenty of room to hopefully pull in, a little overshoot, look below and fail, red to green move, back higher, ends the week somewhere bullish. You know, we can go to the hourly chart just like we did on the S&P. Let's try that zoom one more time. There we go. So you open up here, 729, right? You pull back, you maybe go red to green down here, get back to the opening print, any consolidation here, and then early next week, equal high, right? That would be the most bullish outcome. This will look like a daily higher low, as well as an hourly higher low, right? 1 hour higher low on top of that, noting that this is much more respectful of the gap fill level off of Friday's high. You still have your hourly uptrend via low, higher low, double bottom neckline, higher high, highest high in the trend count via Monday's gap up, and we are pulling back respectfully. Let me be careful with the word respectfully. A little bit more orderly than what we had in the S&P 500, overshooting the key level, right? So this key spot, 723.75, 722 is your must watch as long as markets are above that. We have higher lows across these two time frames. I would try to remain optimistic. If we start to get some kind of an open here that looks like this, different story. I would start being a little bit more concerned because of the way that this was respectful to start. That's a short to get to the neckline of the double bottom back here at 709.75. Okay, that is that one. What you might notice is that we do have this additional gray box on the screen. After the gap up from the Monday session there, we actually repriced the remainder of the weekly expected move, and the box is here. So this is what the market was pricing in from an options perspective on Monday's close for the remainder of the week, right? The market's opening back up here, telling us that, yeah, the market's doing a pretty darn good job of respecting the lower bound of the remaining weekly expected move. And thus, if the market pulls in and supports there again, I wouldn't be shocked to see if buyers try to step up. 722, very important spot in here. Daily 20 SMA, the daily 8 EMA is in there as well. So that's the take. 722 is the key level. Ideally, this red to green, back up here, constructive, all-time highs. If that fails, deeper pullback, neckline's the key level, 709.25. From there, this neutralizes trend. This gets choppy and sloppy. If you reclaim, that would be much more of a bullish situation. If this just blows straight through, goodbye, probably balanced into the remainder of the summer, right? That's it. That's the NQ. We could throw a Fibonacci on this as well, just like the S&P 500 from the high to this low. We've got the Fib 61.8 right in this neighborhood. Once again, this would be more so like if you measure it opposite, it would be bull flag consolidation like this over the 38.2. And your 38.2, in this case, if you measure it opposite, if this was 0 and this was 100, that's your line in the sand, 61.8, right at the neckline of the double bottom. Any sort of coincidence? Probably not. Markets like this geometry, or I should say, I like this market structure. I like the way that the geometry happens to align. Important level, important level. 722, 709.25. Let's keep moving. Let's take a peek at the NASDAQ side of the market internals. Strong volume outflows, just like the S&P side, NASDAQ, or NYSE side, excuse me, get that wrong every time. Same thing here. I shouldn't say every time, just today. A little tired, huh? A little bit too much FOMC coverage. Volatility on the tick cues. Again, I would try to remain a little bit more optimistic. It seems that the market maybe had an overreaction in here. We're being dramatic in the introduction about the worst FOMC that I've seen in a long time. I think the market, maybe has to price in a little bit more of a hawkish stance, and the market did a good job of doing that intraday. But an overreaction, maybe just a little bit. I don't actually think that Kevin Warsh is going to hike rates twice as the incoming Fed. I think that they have room to maybe hike once and then remain very stable there and then potentially start cutting into the back half of like 27 or something like that. But staying put higher for longer, get through this period of like established Fed credibility. Inflation is a choice. I'm going to be a hardliner about that. We're going to be a little bit less transparent. We're not going to have as many press conferences, right? All this stuff. Get through that, but generally that doesn't derail, I don't think, the AI thesis that productivity gains will be a deflationary force in the future, right? AI will be deflationary. That's the idea. Okay, Qs done. Let's jump on into the NQ market profile just to be congruent and cover it. Let's jump over here. Same commentary as the ES. You've got your value area. One thing that I will say is that the value area low is not confluence with the gap fill level. So in this case, I would prefer to just see if you overshoot value and come back in, that could be a potential long for tomorrow. So you'd want to know what that value area is. That is going to be very close to Tuesday's low, but 30,267 on the U contracts. We are officially rolled over to U's all week. We've been using the U contracts, but there you have it. We do have a poor high. I'll just call it out. Why not? It is technically a structure we have to deal with here. Poor high should use repair. What does that mean? If you go through it, we want to see prices test and break that level to repair it. This is the improper end of the auction with A and B periods. So back to back, two TPOs exactly side by side. Let's go back on over to the platform here. Let's reset this out to our IWM. Let's check in on the small caps here and we'll keep moving. Nice 3-day pullback. I'd say fairly orderly. Remember on the IWM in particular, number one, you did not gap up aggressively on Monday. Number two, it's maintained a higher low on the daily timescale, and this can still maintain a higher low on the daily timescale. If you do red to green this, you will be supporting over the daily 20 SMA at 288, which is the bottom end of this balance range. And as the theme has been going so far for the IWM, you get a bull flag back here, you've got to break the low before you go higher. You get a bull flag back here, you got to break it before you go higher. You get a bull flag here, you got to break it before you go higher. Do I have to do it again? Sure, I'll do it again. You get a bull flag, you get consolidation that attempts to start being over the top of the range. You got to break it before you could potentially go higher, and higher, of course, means new all-time highs for small caps. Small caps should be more sensitive to Warsh's commentary, and once again, I would say that this was a fairly respectable pullback into the 20 over key structure, and still with the ability to set a clean daily high or low. We don't have to pull any voodoo magic like what we did on the S&P and the NASDAQ, talking about, okay, daily is this, but hourly is that. No, it's the same here, right? IWM has an opportunity for a very clean high or low 288. Let's jump on into the hourly chart. You can see your volatility there in the after hours. This is 292.40s, 293.40s, so pretty spready, but where does that put you? It's literally right here. An open back at the top of this range. Is this your whoops, higher, something that looks like that? Not bad if the market thinks that it got a little bit too ahead of itself with this Warsh situation, right? The other thing that Kevin Warsh said, and hopefully people have made it this far, is he basically telegraphed that they are going to look straight through the crude oil inflation spike. They are seeing that as a crude shock, and they're not actually treating that as to quote Kevin Warsh, first order effect, right? Or first order impact, second order effects, right? So that's something that the Fed's looking completely through right now. And I think, it's worth remembering that half of the Fed, basically saw, and we'll get to the dot plot, half the Fed said, yeah, maybe a rate hike. The other half said, no, pause, and they'll go anywhere. So the narrative of 2 hikes, which is what the Fed Fund futures priced in, right, seems a little bit aggressive to me. Yes, inflation is a choice. It was very hard line about that stance. I think Kevin Warsh is, maybe a little bit less charismatic than Jerome Powell, very kind of media trained, it seemed, when he came to the podium today. But he's not silly, I don't think, and he knows that he has to establish Fed credibility, right? So he's doing 5 task force, you get a task force, you get a task force, you get a task force to do so. Jokes aside, here on the IWM, bullish for small caps, generally a tailwind to the market, S&P 500, and the market maybe got it a little bit too wrong right off the open there. So that's kind of the take on that. As we throw on the anchored view apps for the IWM, just to be congruent in covering it all, if we are above this, that looks pretty darn good. Here's your pretty much all-time high anchored view app. This is the news candle anchored view app. This would be the all-time high for the S&P and the NASDAQ, and this is the day that changed character. Notice that you're completely above these two, and the gap open forecast, as of right now, is potentially suggesting above all of them. That looks pretty darn good to me as it relates to IWM. Shakeout, oops, everybody gets short, and then pinch. Sayonara, nice knowing you. Let's go on over to the Russell side of the market internals, see what we have here. No shock. I mean, one thing I will say, this was an expectation misalignment problem headed into today's session. Why would I say that? We were talking about it in the group most of the morning, all day long, and ignore some of these VWAPs. They're just miscalculating because of the way. Let's just do this. There we go. All morning long, this is the start of Wednesday, the market was trending higher on small caps. This is the market saying, hey, we believe that Warsh is going to be like ultimate dove, right? Give the market exactly what it wanted. So it's an expectation misalignment, right? Everybody's like, okay, maximally dovish happens to be that he's kind of hawkish, right? And let's reprice that. But maybe this was just too high to begin with. The market experiences a natural pullback, and this is the sweet spot, right? And this was like too much. Like, okay, we got a little ahead of ourselves here. And this, on the same flip side of the token, this is a little too ahead of yourself on the hawkish side. And instead, your equilibrium's there. And now we just go back to trading based on the assumption of, okay, we got a little shaky. What's the next catalyst, right? And in the after hours, one of the reasons that the market may be higher is you have the confirmation of that signing of the MOU from Trump, as well as the Iranian minister there or senior negotiator to ultimately say, yes, we both agree to these terms, right? That's the situation. Let's keep moving. We talked about the Russell from a volume perspective and expectations perspective there. It's an unwind for sure. This, not the end of the world, not in trend lower zone, and not really a bad bearish build on the cumulative. I think you've got an opportunity here ultimately to see if the market can prove itself tomorrow and hold in there, squeeze out some of the shorts who are late to the party today. That is that. Let's jump on into here we go. Market profile for the Rusty Russell. What do we have from this perspective? Extremely poor high, right? J period up there, just like lack of material excess, flat across the top. The point of control did migrate lower here on Russell. However, once again, in the after hours, if we're going to open on a suggestion of a higher level, these shorts, if you're short there, you feel like this. If you're long there, you feel like a super genius. What's that an ingredient for? Well, if the market does not get underneath that point of control, you're probably higher, squeezing out shorts and continuing to catch a bid for smalls, right, as a risk-on approach there. Let's jump back on over to the platform here. Let's get into our S&P sectors. Let's see what's going on from this perspective. Starting with the weekly performance, we've got financials leading the pack, followed by industrials. Bottom of the barrel is right here. IGV down about 3.27%. That's software, followed by semiconductors down over 3%, 3.03. XLRE real estate down 2.97. Makes sense with this more hawkish tone from Warsh. As we jump into the structural charts here, even though the XLF is up the most, it probably looks the most susceptible to a pullback in here. Just too far, too fast. Come on in, give me a higher low in the neighborhood of the daily 200, and then let's try it again. Let's try to sustain this trend in the upward direction. That would be a really reasonable look for the XLF, and I would also echo the sentiment of what we talked about in the Saturday update video. You will not lose the S&P 500 if the XLF is trending higher. If the XLF and financials are acting well, the market has the ingredients to, at bare minimum, be rotational and act sideways. It might not be straight up, but it's rotational and sideways rather than down. Financials need to be getting absolutely bludgeoned if you're going to have a sustained sell-off through all of the sectors, right? So pull back here. We'll see if the baton can get passed over to some software / tech. XLI looks like it could close the gap in here, offer a higher low. The trend will remain up. That's constructive, and upside here is great. This is still about 8% of the S&P 500, a meaningful chunk. IGV looks horrible. We'll see if this is going to give us a look below and fail of the 50 and then back higher. I would really prefer that this maybe starts to suggest double bottom over this neckline 93.50. If we're going to start retargeting the daily 200, this pullback here, this unwind, just a little bit too much to be constructive, right? This is like too far, too fast. Okay, cool off, but keep it in here. Ideally, it would have been right around, number one would have been 100. Number two would have been this gap close in here. None of that happened. So I've got to be a little bit more skeptical of IGV, but I would also suggest, and we've been talking about this around the channel, there's two categories of IGV. There's the winners and there are the losers. If you just put this table up real quick, your losers: Microsoft, loser, right? ServiceNow, loser. CRM, loser. Monday.com, loser. Workday, loser. Adobe, loser, right? And the list goes on. The winning categories, well, probably PANW, Palo Alto, right? Cybersecurity, CrowdStrike, trying to act well. Fortinet, trying to act well. Dokken, not DocuSign, but DigitalOcean, right? Acting well. Those go on the winning side. So this is heavily weighted towards Microsoft. It's heavily weighted towards, even Palantir is on the losing side of the ledger. It's heavily weighted towards that, and that's why it looks so bad in my estimation. But if you're trading the winning group, just kind of don't conflate this look with all of software is basically what I'm saying, okay? That's IGV. Let's move along to SMH. Inside inverted hammer. That looks heavy. Like, there's no denying that looks heavy. In the after hours, though, I mean, they're picking it right back up. 637.88 by 60. So that's already back up here over today's opening print. Does this just flag out and then you say, oh, look, this is fine and we're just pinching in semis again? Maybe. I have to imagine the pressure's on. Anybody who's trying to short this as like an overextension gap and looking for this market to maybe pull in and go sideways for, as we said with the S&P, months or a month, a couple weeks, 3 to 5 weeks, you're just not getting that, right? So an open here will put the pressure on shorts. I don't know how many people want to go out short through the weekend. I also don't know how many people want to go out long through the weekend. So you could get some push and pull tomorrow. But so far, the open higher, that's interesting. That's pretty telling that you certainly have, in terms of daily trend, higher low, and consolidation here is really, I would just say, bull flag, right? Let's jump forward into the XLRE, really taking it on the chin from the commentary about being a bit more hawkish than dovish. Lightweight sector, it's also a little bit more defensive. I'd be neutral in the midpoint of the range. This was crazy that it was trying to break out anyhow with what rates were doing, so I'm not fully convinced. Let's go on over to XLY. This is a very tough look. This is terrible with a little island reversal here, losing the moving average stack in the after hours. You're slightly higher, but you're spready there. This needs to establish dominance and a higher low tomorrow over 116.25. If buyers cannot do that, this is just naturally in a downtrend, right? That is a short-term downtrend in here with a lower high and a lower low. So hard to say that this is constructive. Thank you, Amazon. Thank you, Tesla, for acting like absolute dogs. Speaking of dogs, Meta is a dog, Netflix is a dog. A lot of these things in the comms sector do not look great. Breaking to a new lower low, this is a problem, right? So even if this does start to suggest an open higher, right, you have a lower high. Even if you rally over 110.50, you still have a threat for a lower high, and suddenly your SMH and your XLF are the only things where, number one, XLF looks like it could pull back. Trend is up, but it looks like it could pull back. SMH is like, do we really want to be buying this up here into the long weekend? Maybe people don't want to be short, but do we really want to be buying it there? And then you say discretionary doesn't look good, comms don't look good, and suddenly, although I might pound the table for structural trend count and the SPY is up, your supporting evidence is not really like stellar through the sectors. A much more meaningful lower high over here on the XLK, right? That is a notable divergence there. You do have an opportunity for a higher low at the daily 20. After hours is slightly higher, 88.97 by 189.61s. So that would put you right in this neighborhood. If we gap green over red, I think you could potentially squeeze, and there's more of an opportunity for that in the XLK versus the SMH, I believe. Let's go Mag 7 ETF. This is brutal. Horrible heavy close today. Again, slightly higher in the after hours, but not fully. About 65 flat. That to me looks like a potential lower high on the open, and then continuation lower. We know the Mag 7 has been incredibly weak. It's been select semiconductors and the new kids on the block that have kept this market afloat, but this is not the look on the Mag 7. Let's go from there to the XLP. I would say this is another heavy close. I would say that this to this is maybe a higher low, but consumer staples pulling back, defensive. I don't think that this is all that constructive for markets. It doesn't really move the needle for the S&P 500 interpretation. I would kind of let this be in the meantime. XLV, healthcare does look good for a potential higher low in here, especially if the market's going to say, okay, let's take it easy on tech. Let's rotate over into XLV. So that rotation goes back on the screen. XLV, XLF, those are the places where there's a little bit of a hideout. And do we just kind of look below and fail the gap back higher? It's a possibility. I'd be keeping an open mind to that on this XLV. And primarily, keep in mind, XLV is, you want to look at your CVSs of the world. Let's just start here. Let's go UNH, right? You want to look here. You want to look at Humana. You want to go ahead and look at, Oscar even, just to throw a little high beta in there. I don't necessarily think you want to go full-blown risk on and look at the XBI. I do think the XBI looks great here, and I would like to bring it up in context of the XLV, but this is not your defensive healthcare. This is your risk-on healthcare. And actually, it closed well. It closed well today, not giving back this breakout. I don't think that this is just a blind long here, but if we could tighten up over the breakout point, that is something that we would be interested in the upward direction. It's XLV. Let's keep moving over to the XLB materials. I think this could pull back for a higher low, but it does look like a failed breakout to start. We'll see what happens with this 5230. Let's jump on into the XLE. Energy, you're going to get smoked on energy tomorrow morning as the MOU gets fully agreed upon and the strait reopens. Crude oil continues lower. Energy prices probably continue lower. I think the daily chart, still is, or even the higher time frame, like a weekly chart, still suggesting that this could easily pull back, set a higher low and go. Not to put my tinfoil hat on too much, but who knows? Maybe we sign this thing, crude oil gets crushed, and we pull back and look like this. And then in the future, this is a monthly chart. So keep in mind, a couple months from now, September, October, something like that, we're in here, we're retesting the top of the range, and something breaks again over in the Strait of Hormuz. Or, oh, we don't like the way that this has been carried out. Or, oh, we don't like that, right? And then you get this higher low. Again, a little bit tinfoil hatty, but something to think about. Let's keep going, though. Let's take a look at the XLU. We don't need a monthly chart for this one. On the daily, just a little bit of a rejection back down underneath this flat set of lows at 44.75. We'll take that in stride. It's such a lightweight sector. It's also defensive. Don't really mind this. Downtrend, yes, but not a heavyweight. Let's jump on into some ratios. Let's blast through the supporting evidence. Let's get the job done here. General character changes are what we're looking for. If you're not familiar with ratio charts on Thinkorswim, check out the video tutorial top right-hand corner. This still looks great. I love the XLF perking up here. Again, that speaks to rotation and sustained sideways, not down in the S&P 500. This is still problematic. This is still problematic on comms. We don't really have risk off, so I'll put a little check and squiggly over here, check and squiggly over here. They could easily get into it, but so far it does look like we are rejecting declining 50 SMAs instead of cleanly recapturing them. Let's jump on into our A set. We could see on this front, looks okay, right? Looks okay. Squiggly looks okay. Squiggly. This is like, don't really love this. Kathy's still underperforming. This probably gets an X actually as well. Apples to apples, XLY, XLP, and IWF, IWD back on this low, probably a problem as well. Let's go from the A set to the B set. So, that's like a mixed bag there through that perspective. Let's go to the B set. This gold ratio still seems to signal risk on even after today's hawkish action. This over here in Bitcoin, bouncing off the low, I still think you have a lower high there. This has been a problem for the market for a while. The market doesn't seem to care, right? Obviously, the S&Ps went out to brand new highs, so did the Qs, and Bitcoin did nothing. So I'm not holding that against the market. This TLT ratio is, still in the confines of a massive bull flag, so I would not be worried about that one. Not HYG, but HG for copper. Put in a nice equal low here. This lower high is not great. I would love to see if this can't turn around and make an equal high. That would be a bit more of a confirming bullish risk on signal. If we take the lows before the S&P takes the lows, hey, heads up, it's a little bit of a bearish divergence, right? Let's go from the B set over the dollar and interest rates. You can see the dollar clearly perking up, right? And then you can see interest rates, a little bit of an uptick here. They should probably open higher on tomorrow's session. Let's jump into the inverted ZT just to show this one. We haven't looked at this on the channel in a while. Excuse me. This is the inverted 2-year rate, this moves in the direction of rates, which is inverse to the 2-year note, right, which would be down. Anyways, equal highs, just suggesting that once again, pricing in those rate hikes rather than rate cuts. Rate cuts would be down here, breaking this low. So let's jump into the Fed tracker tool. Let's get a little bit more granular through what the Fed said today, as I lose my voice apparently. And let's go over to the statements. This I thought was interesting. Kevin Warsh is a big fan for streamlining and being a non-interventionist at the Fed. This is Jerome Powell's last statement. Okay, that is, if I pull up on the notepad on another screen, that was approximately 341 words. 341 words from Jerome Powell in the statement. Here is Kevin Warsh's statement. Kevin Warsh's statement is less than half that, coming in at 105 words in the statement. I mean, just incredible, right? So a lot less detail. Kevin Warsh is likely to be less transparent than Jerome Powell and the previous Fed. Here is the statement of economic summary of economic projections. The market freaked out about this number right here, 3.8. 3.8 technically implies that we will have one rate hike into the end of the year. The market had priced in two. If we go down to the dot plot and we scroll over here, you could see that some Fed members do actually pool up here. This is also what the market freaked out about. They pool up at about a 4.1. That is where you're getting your two hikes from, but this anchor in here, which is actually more unchanged than anything else, right? That's right here, 350 to 375. That's kind of where I think we say, okay, hang on a second. Is the Fed actually going to issue two rate hikes? Probably not. And instead, generally, the Fed sees rates moving lower over time, and the anchor here probably keeps things tame. Maybe you get one rate hike if Kevin Warsh really wants to say, aha, I'm going to prove that we're going to be credible, right? But probably not two. The other thing I wanted to scroll down to and just take a look at is if we scroll down to the balance of risks. Apologize for all of the scrolling, but here we go. This is GDP. This should be employment next. There you go. This I thought was pretty telling. The Fed sees less of a risk to the unemployment rate, sees that as a broadly balanced risk versus what we had prior. You could see, just a big downtick from the dotted, which is the prior SEP, to the current. That's telling us that, hey, where are we focused in terms of the dual mandate? Remember that the Fed has two things, just to go back to Fed 101, right? You have labor over here and you have inflation over here. Kevin Warsh is basically saying, forget about the labor market. We care about inflation, price stability. He said it's unambiguous that is our objective, right? To restore price stability, 2% inflation. Speaking of inflation, he's able to rally the troops behind this idea that, inflation risks are weighted to the upside. We do not want inflation staying, in this territory. That's not it at all. So that's interesting. The last thing I'll say here is you might say, like, okay, well, hang on, where'd this final participant go? You're seeing that the dotted line, or this round went lower versus this round same, right? So where's this final participant? Kevin Warsh didn't even include his own votes in this SEP, just for what it's worth. The other thing Kevin Warsh did he specifically went out of his way in the commentary today to say that the dot plot is, it's a snapshot in time. And Jerome Powell used to say this as well, but Kevin Warsh made it abundantly clear that this is a moment in time. I think he used the term, when people submitted their dot submissions, which I know is redundant how I just said that, they came with their pencils in hand. And then the comment he followed it up was, the ones with the big erasers on top, meaning they could change their mind on a whim, basically. So I think they're downplaying the dots and saying, like, this is going to be less important going forward, and we're going to sort of let the market do what the market does, and we're going to sort of take a step back. Kevin Warsh said that they want to be less about the market trying to forecast how the Fed is going to respond, and instead more about the Fed interpreting the market's reaction to data as being authentic and pure and using that as a data point itself. So interesting from that point of view. Anyways, jumping over to the Fed Watch tool here, this is probably wrong with the futures pricing in the after hours. Your sustained pause here, there's your hike, right? There's your additional hike, here. And then you're probably backing off into the end of 27. So we'll see how that settles out. Fed fund futures are always volatile on the FOMC. We'll see ultimately where that goes. We could jump back on over to this tab because why not? But there's really not much to glean from. We want to be on, where is it? Earnings calendar. There's nothing here, right? Kroger before the open tomorrow, give me a break, right? Let's go back on over to the platform in the spirit of moving forward and take a look through the remainder of the supporting evidence. We'll get you on your way for a Wednesday afternoon. We do have inflation expectations plummeting over here with the signing of the MOU and just positive de-escalation developments in the Middle East. So this is constructive there. And this is officially a downtrend, by the way. We actually broke yesterday into a lower low. Let's go ahead and go from bonds over to credit spreads, continuing to push lower here, which is bullish. This one's kind of neutral. Want to make sure that it doesn't blow out through this high. If we're just balanced in this range, oops, like this, then no problem. Wouldn't be overly concerned. Let's go from credit spreads to junk in isolation. You could see coming in that kind of aligns with the market here. We'll watch for the next divergence. As of right now, there isn't one. Let's take a peek at our breadth ratios and additional indications there. You can see a sharp coming in of breadth. I think reasonable considering the liquidation that we saw on Warsh's interpretation. No new highs versus lows going negative. This is a little bit sustained near the zero mark. Not overly concerned with that. RSP, no problems over here. Staying over 211. If it does pull in deeper than 205.50, I would be concerned. This generally just wants a weekly higher low over that level, sustaining the left side all-time high breakout. If we go to the QQQE, very similar to the Qs, very respectful of this area. Gap fill reversal, a little bit of overshoot, but primarily looking at the Tuesday high of last week. As long as we stay over that, I would generally be a bit more bullish on breadth. Let's go from breadth over to our volatility index. Of course, your VIX perks up today on Warsh. It will likely fade off tomorrow. Just noting that the volatility is going to be in the rearview mirror. The uncertainty has been washed, or should I say washed, from the calendar. Let's jump on into our VVIX. Perked up, but still well below 103. This is important as a comparison back to October when the market produced that big kill bar, right? We were making these comparisons back here. Oh my goodness, inside day. It's different, right? Your volatility is not perking up like you had in October of 25. And it honestly looks pretty good. It's even more tame than this reversal here into the end of August, or I should say early August, late July of 25. Let's go from there over to our vol futures. Screaming into a contango into the end of the day. Incredible. Unless we have a VIXpiration here, which I don't think we do, but maybe I'm lying. Let's go to the VX and see what we have. Yeah, 35 days on the N. Oh, today is, expiration of M. So yes, that is incorrect. And if we just go look, ignore the bright white line, but do take a look at the gray line. That is bullish there, still in contango. This close enough to contango. Your one-day VIX likely fades off tomorrow with Warsh out of the way. So not really seeing a huge problem set through the volatility side of the market. Let's quickly hit the core list of companies. This is heavily weighted to the Mag 7, so be prepared for some ugly looks, even though we've just said that some of the supporting evidence, sector-wise doesn't look great, but S&P, NASDAQ-wise, I think there's room for higher lows still. NVIDIA, not really. Maybe inverted head and shoulders here. I would need to see a gap up green over red to pinch out shorts and a Brigade bolt over 211 to do something that looks like that. That's probably the only way I'm really excited about getting long NVIDIA tomorrow, just on a technical pinch on a gap up. So you got to open like 209 or better. If you open 209 or better and then Brigade bolt intraday, that's what I'll be looking for, and squeeze, we'll see where it goes. If you open in here, probably just letting it be, and then we'll figure out whether or not this is a, with the broad market long next week or short as a bear flag down here. Let's jump on into Apple. Apple failing the retracement. You could say this is just technically a bear flag. I kind of like that look. Failed breakout in here. A lot of disappointed longs who thought this thing was going to retrace and go to the moon. I don't know. I think Apple, it's defensive tech. That's really all there is to it. If the market overreacted to Kevin Warsh, maybe the risk on tech gets a bid, and then your Apple as the defensive look just kind of dribbles lower and stays put in the flag. That's one situation. So going over to Microsoft, this thing is toxic. It will be on sale at some point. It is slightly higher in the after hours, but not high enough to do anything meaningful. You're opening here, at least based on this forecast. We'll see what we have tomorrow morning. I don't like this. This is undeniably a lower low. I think you have a lower high, and we're just looking for lower. So nothing to really do about Microsoft. Amazon, I think this is just a classic lower high H pattern here. I would be willing to try this long against a look below and fail against the 200. If you can get red to green on Amazon, it might take a little bit longer here. This double bottom might take some time to build out, and then you're here eventually. But to try it at least against the 200 seems to make sense. I do think Amazon's still a winner of AI, and look below and fail on the 200 could be interesting to 247. Moving forward to Google, this was one of the stronger Mag 7 names in the range. It just parked itself in the middle of the range, not even close to making a new low. So I'll give it the credit there, but do I really want to be fishing for longs or anything really in the middle of the range? Not really. The idea here would be let this thing turn into inverted head and shoulders, let it set up, tighten up over here, and then maybe there's a long up and through the top when and if the broad market seems ready for it. Looking at Broadcom, this is still just a bear flag to me. Any lower highs sub 408 looks like a short, something that looks like that. If you had stronger buyers, on the earnings gap down, this should have held, and then you're like, okay, let's retrace a little bit of that. You guys got it wrong on earnings, but instead, all of the action since earnings has been underneath the overhead supply. Moving along to the metaverse, another ugly bar over here. Great short rolling off of the 20 SMA and ultimately parking itself towards the equal low. I would think the idea is if you go for a counter trend, you need to see these bear flag lows at 582.50 act as resistance, show me the lower high, this builds a little descending triangle, and then this gap close becomes the look. That is it for Meta. If we do open higher, this has a lot of work to do before I'm really interested in longing it. I can't really see myself wanting to get big long into this daily 20, this overhead supply. If this is going to be a double bottom, fine, get me back here, show me some tightening up, and then maybe there's something to do to the 50. I don't even like trading the retracement through the structure. Let it go, let it do whatever, and then if it wants to prove it back up over here like it tried to do with Meta 1, then maybe we're interested, but it's just, I mean, look at what I just drew there, and look at what's actually happening. Right? It's like such a stretch of the imagination, so we'll keep an open mind, but not ready. If we go to Tesla, I don't know. In this range, I'm not convinced. I would let this chop and grind around in here. I've been pretty transparent in the morning shows, with the group, with everybody. You either got to be Brigade Bolt high or low squeezing up over this, and that's at daily 200 SMA, daily 20, that's at 415.50, or you got to be maybe trying to buy this low if you're a believer of Tesla. If you're in here, just nothing to do. I don't think you want to waste your time with this in the midpoint of this little range here until you do this or until you do this, right? And clearly shake that low out. Let's go on over to JP Morgan. Bullish for financials, of course, could use a pullback. Brand new all-time high. The big banks look great. Goldman Sachs taking it to the bank with the SpaceX IPO. Morgan Stanley taking it to the bank with the SpaceX IPO. JP Morgan, of course, getting a slice. Who else? I mean, you name it. Bank of America up there towards all-time highs. The laggard was Wells Fargo. Wells Fargo is trying to catch up, but not really doing it. Citibank as well, taking it to the bank, literally on I'm sure fees and whatnot. So those are your banks. They look good for the XLF. Even I think MasterCard, if I'm not mistaken, had an uptick. Maybe was it Visa? There it was, Visa. Visa tried to reclaim the daily 200. Couldn't really get a good footing there. But your big banks are running your financials. Let's keep going. MU for the core list of companies. Inside, we made a slightly lower low, not perfectly inside, but little doji bar there after a gap fill reversal. If you're over 1,000, I don't think you can complain about MU. Should this thing end up gapping up over, you see a 1090 open tomorrow morning, pinch away, maybe back to that overnight all-time high. Is that going to be it? Are we going to start this parabolic blow off on memories? I don't know. It seems like there's just been such a sustained bid under these things that this higher low is hard to ignore. And if you gap green over red after an inside day and the potential for a shake, a gap fill reversal, I don't know how those shorts aren't shaking in their boots, potentially getting ready to stop out of that thing. So 1090 open tomorrow is pretty interesting on MU. AMD, let's see what we have over here. I would say, of course, your squeeze open is gap green over red. That's north of 530. A little bit less likely over here, 524s in the after hours. I actually shouldn't even say that. A lot can happen between now and 9:30 tomorrow morning. It seems like the close here seems heavy, but if you gap it to here in Brigade Bolt, it's how I just don't know how I would maintain an overly bearish stance unless those just turn into failed gap ups and we do not hold over opening prints from today. If you get a failed gap up that looks like this, then fine. I think that it's probably just a hands off. Don't try to long that as opposed to get max short and expect this thing to crash and burn into the gap. Let's go over to Intel, the stock of the century. High tight flag still in play, inside bar. Please, let's see this thing through the highs. Right there, right? A lot of people bought the trendline break in here. This seems like an okay retest of the trendline break. I'm not a big fan of trend lines. You could have got this thing long off the 20 in here, gap fill reversal. Could have got it long in there. Could have even got it long over here. Generally, I am long Intel from 3 different spots all through this move. And I would like to see this higher. Absolutely. Just to be transparent, I'm with a lot of those folks looking for Intel higher. If you can consolidate and Brigade Bolt up and out, awesome. As long as this stays in the flag range, I think you have room. Daily 50 is going to start creeping higher. That will help guide us for a stop, right? This is not Intel to 140 on a breakout. This is Intel to like 200 on a breakout. So just keep in mind that's the high time frame pattern. You, of course, have to execute based on your goals, your objectives, your risk tolerance, and where you think we land from here. Moving into these trade ideas, CRWD, CoreWeave, is up first on the chopping block. This is actually a short. I thought it was a short today. Look above and fail from the prior day's high. And you could have gotten it from the FOMC in here. But I think it's a short even still on any rejections of this range and lower highs under 116.50. In the after hours, this too is moving higher, 118.60s. in this neighborhood. So an open in range that fails 116.50, I think goes back to the 50 SMA. So that's the look there. Why CoreWeave? Because it's been acting like garbage compared to some of the other, I should say higher time frame garbage compared to some of the other data center leaders. Just go to NBIS, right? Look at NBIS here, and then look at CoreWeave down here. Is there something to it? Does it have a weekly character change with higher lows? Sure. This is a short-term trade. I think you have a day trade tomorrow on this into the 50 on an inverted hammer rejection of this high. Too far, too fast. 4 days up. Cool it off. Pull it back in. Test the daily 50. It's possible short. That's CoreWeave. Next up, FRMI, Fermi. I don't know how you get involved in this after a day like today, but this has to be on your radar. I think at least big volume accumulation down here. It's been straight up. Again, I'm not advocating for just brand new blind longs here. If this can firm up over 725, daily high or low, sure. I think it's worth giving a try. Keep in mind, average ATR here is about 8%. So be respectful. No need to just have a wide and loose stop loss on this thing with max size. Let it tighten up, let it come in, let it offer a daily high or low, and let's see if we can't find ourselves into this thing for a potential play in the upward direction. That's FRMI. Myrna, MRNA. Let's go to Moderna. This is a weekly chart play. This is a classic cup with handle. There it is, breaking out. We know that healthcare and primarily that XBI looks pretty darn good. Is this going to play a key role in higher? I certainly think it could. Again, like Fermi, this is not ready for just being bought immediately tomorrow. But if you could tighten up, stay over 57.65 and go, that looks pretty darn good. I like the volume coming into this on today's session and even prior day's session. Look at the volume uptick happening over there. Myrna, we go to PANW. Already own this name just like Intel. Own this from just in here. Over these highs, right? Nice strength in these cybersecurity names. I think Palo Alto is one of the ones with the best strength. You look at a CrowdStrike here for a second, and you're like, okay, you kind of got this break, but you're maybe not pushed up as high. Fortinet, I thought looked okay today for a potential watch up through 150, but I think Palo Alto for now is still the horse I want to stick with, and we'll see if we can't get up and out into these highs back over there. So that's it. Those are, I should say, the 4 additional trade ideas I have for you in today's episode and installation of the Midweek Market Update. Hopefully you guys enjoyed your FOMC session. Little bit too far, too fast to the downside. Looks like markets are trying to revert that through the overnight with the positivity in the news from the signing of the MOU from both of the leaders, Donald Trump here, as well as Iran's top negotiator, I think was the person who signed it. Let's see, signed by the Iranian parliament speaker. I always butcher his name, so with apologies, Qualibaf. VP Vance, parliament speaker Qualibaf signed it on Sunday, and then Trump and Iranian president signed subsequently on Wednesday. That is the official news as of 1 hour ago, about 7 p.m., 7:30 p.m. Eastern time. All right, have yourself an awesome rest of the trading week. Remember, markets are closed on Friday. Come back out to the show tomorrow morning at 8 a.m. Eastern time. We'll see what happens overnight, and we'll build a fresh game plan for the day ahead, 8 a.m. here on the channel live. Be there, and have a green rest of the trading week, and I'll see you in the next one.